Hello, good evening, everyone. Can you guys hear me? If you can hear me, can you give me loud and clear so that I know that you can hear me? And please come and say hi, and don't forget to help us to share this video. And we are now actually tonight going to talk about Singapore market, and I think we will share quite some important information that of course we're going to talk some case study later on. So don't forget to help us to share this video either to Facebook or YouTube. Right, thank you everyone, thank you, Happy, Swee Kiang, Jojo, and Wendy. All right. Let me change my layout a bit. Okay. I forgot to introduce myself. My name is Chris. I'm a research analyst at Equity Tracker. I'm a research guy where I'm focusing on Malaysia stock equity. Okay, so when normally we look at the stocks, right? We look at the fundamental basis. Personally, we analyze on the fundamentals like financials, performance, and management quality, right? We also got educations on the technical side, but I'm not an expert in that. But so tonight, what we're going to do is that talk about a lot of things about fundamentals. We're going to talk about some stocks in Singapore, and basically, the most important thing is our title tonight: crisis-proof investing. I think most of our audience tonight is actually our Malaysian investor, right? You are probably you are invested, or you haven't invested in Singapore market, but I think probably you should try and consider have some exposure in Singapore market. Why? Looking at a financial perspective, a lot of Singapore companies actually have a very good and strong balance sheets and financials number. In terms of valuation, compared to Malaysian company, they sometimes a lot of good companies out there are even cheaper than Malaysian landscape. So why not take a chance and try and study on the Singapore market. And tonight, my job is here to help you guys. Basically, we're trying to look at what are some of stocks that actually basically are crisis proof, right? And how are we going to find safe and high growth Singapore stock exchange stocks? Okay, without further ado, let us start our tonight presentation. Okay, as usual, we will have this disclaimer. And because this is a stock investing webinar, of course, we're going to talk about some stocks, but by no means this is not a financial advice. It's just for educational purposes. So we are going to talk some stocks. We're going to run through some screener. So this is not, again, this is not stock tips, basically. All right, why we using the title that crisis-proof investing? If you look at the stock market recently, right, in be it Thailand, especially Indonesia, and also Malaysia, a lot of actually you look at a lot of stocks in Malaysia now is almost like a COVID-19 period, right? 3 to 5 years low at a share price. So if you look at it, this we don't, and also the Trump come to become the US president in January. There's a lot of uncertainty impacts in the market, where we don't know somehow that impact will likely to spill over, or that a contagious effect will likely to come to impact our Southeast Asia region. I look at this chart. Basically, I will just bring out some regional indexes. It's Thailand Stock Exchange Index, and also Indonesian Jakarta Index. Both are down recently. Look at Malaysia KLCI. We also dropped quite a fair bit, but Singapore, they are performing very well for the past 5 years. They are also showing a lot of improvement in terms of the performances of the company and also the share prices. Thus, Singapore Stock Exchange has not been impacted. So I think this somehow shows some resiliency that compared to other regional markets, Singapore market actually are more resilient and more stable compared to other market, for example, like Malaysia. So please consider to look at a lot of Singapore company. And just a brief summary on what we're going to went through and what likely you're going to learn today's session is that how the recessions and resilient stocks, and also we're going to talk some case study, and also later on we're going to run through our ET smart screening technique. All right. Less understanding some of the recession resilient stocks. Okay, we are not in a recession, of course, currently, but as economy move in cycle, we are when things go up, definitely sometimes things will come down also. So we just trying to prepare for the bad times, So and to protect our wealth, to protect our money. And most important thing is when we try to invest, right, as a savvy investor, we should look at what are the stocks that actually some kind of crisis proof. Because when crisis come, a lot of company can go bust or disappear after the, let's say, COVID, because the disruption. So basically, what we mean by crisis proof is that there are some companies that actually have the very strong balance sheet and consistent cash flow that can weather through all the bad weathers. And one of the key important criteria for a crisis-proof company is that the company products or the demands and the services, the demand for the product and services is very insensitive to the economic cycle, right? So what I mean by is that when economic go down, they are likely continue to generate stable income and revenue. And also, what is another important factor that contribute to a crisis-proof stocks is that a low debt company actually can perform better during a crisis, because when a company is highly geared, that likely to be beaten down when the interest rate go up, or when the business actually facing some disruption, and they have to continue to service their obligations by paying their interest and paying the banks, and yeah, so low debts company are definitely better in terms of the balance sheet management lah. So another way to describe crisis proof, we can actually using this called defensive sector, right? Defensive, more on defensive play. And let's say when the economy go up and the GDP are growing and the unemployment rate are low, basically the all economic and company are in the expansion mode, right? At that time, you can actually investor can be more growth hunting, right? Seeking for growth, seeking for higher return. But if the economic go down, this kind of company or in the cyclical sector, they are likely to suffer as well. So for a defensive sector, then which means they can continue to generate stable revenue and profit even during the economic downturn. Because they sell the essential goods, making them more resilient when compared to when the consumer spending drops. So can somehow protect your investment and your savings. Okay, so what are the sectors that basically this are not applied to SGX, but the sector wise is actually applied to almost every single stock market. But for example, consumer staple, They are defensive in nature, healthcare and healthcare related services, utilities, and REITs. Depend on what type of REITs, but certain REITs. So these are the sectors that actually they have their resiliencies during the economic downturn. Yeah. Next, we're going to because as a value investor, we should look at some numbers, and we should also have some knowledge on some of the key financials number. And why? Because all these companies reporting numbers, right? Don't usually lie lah. Numbers don't lie. So that we can use all these metrics to spot some clues. I'm not saying that all the reporting's number for all the PLCs are 100% correct, but we must say we must use this some of the numbers to judge. So so go back to our topic is that the key financial try to look for for defensive stocks. For example, we can look at the consistent dividend company. So as an investor, the actual dividend is the amount of cash that we receive from the company. So when the company pay out cash, it's really have it is actually means that the company really have to pay out the certain cash from their bank's account, and they must be have some strong cash flow that to support that dividend paying decision, right? So the second point is about low debt, right? Because in the economic downturn, a lower debt level means a less risk lah for their financial distress in the downturn. The third point is about high return on equity, ROE. What we're looking at this financial metric is that like this is best to have at least 10% of ROE, and also profit margin. Because why? The ROE is a measure to how efficiently the company generate return for shareholders using equity money, right? Equity is the money that actually you borrow to the company without any interest, right? And the profit margin means indirectly as a pricing power that you can how well you can price a product, right? And the fourth key point is that looking for a company that has actually have positive and consistent free cash flow. Because if a company without cash flow, it's very hard for them to continue to sustain, because they have to pay their supplier, to pay their salary. So business must generating positive free cash flow or operating cash flow that so that they can be self-sustaining. So if they have positive cash flow, they can consider to reinvest or even paying dividends. So for defensive sectors, most likely you should look at these four criteria, so that you can have a very low risk and stable return for the longer term to weather through all the storms. Right, and all right, the next slide is talking about management quality. I think the management quality is some kind of qualitative analysis, right? It's not reflecting in the financial number directly. All right, you cannot go and look at the financial report and find out what is their management quality, but over time you can actually through some of the financial number to observe some of the management quality. But back to this, yeah, as an investor or even a potential investor, before you invest, we should look at the management track record, and and if the management has very strong track record and continue to deliver a good set of results across multiple cycles or downturns, it somehow shows that actually the management are prudent enough to run the company very well, right? And this is the one of the most important criteria. And we also can use some of the past behavior as the best indicator or the predictors of the future performance. right? And another management quality that we we are focusing on is on the adaptability of their market changes, because if you think about COVID-19, when COVID-19 came, all the things has suddenly changed overnight, right? Lockdown, your disruption, your supply chain, your cost, your some retailers cannot have to close down and zero income for them, right? So how fast can they adapt in the change in operation? How fast they can cut their costs, or their shipping their supply chain, or change their product mix. Um, of course, the technology also keep on changing, like AI and new tech, right? So how well can they adapt to this all these new changes? Okay. Of course, management has to be transparent, and so that transparency that can keep the investor or the stakeholders remain confident lah. Um, and the management quality, somehow we can look at some of the capital allocation strategy, how they putting money for the best use. Basically, either they going to reinvest, share buybacks, or if they got the excess cash, they will pay dividends. Okay. Of course, I'm also putting some red flags here. What are the things that we should avoid? So we do we do not like some of the company that actually keep on buying new companies, that keep on doing M&As that grow their business by acquisition, because if you have if you keep on buying new company, every different company has a different operating culture, right? Company culture different, and the different leader. When you're buying over, the original founder is no longer the largest shareholders, which means they have the less motivation to work for the best for the company as well. So and especially as things get worse if the company buying some company at a very high valuation, and fail to deliver their promises. And if the company keep on buying company and issuing new shares to acquire, that issuing of new shares likely to bring some dilution effect to the shareholders' earnings. All right. Another key factors or key criteria that we should look at when we're analyzing defensive sectors is that the company should have a strong business model and pricing power. The mod is actually is to protect a company profits. If it's good that actually if a company moat is durable, competitive, it's actually is the durable competitive edge, yeah, that protect a company from the competition. So what are the example of a moat is that a brand, the brand branding itself, right? How strong is the brand in the market, and cost advantages, network effects, and high switching costs, IP and tech, technology, etc. Right? Some pricing power. Then, if the company have an ability to raise products prices without losing customer, then we can consider that the company has certain pricing power. Why these two are important? Because if mod combining with pricing power, basically is we call crisis resilience, and the company can protect its profit margin when the input costs rise, especially during inflationary time, or even has a supply shock. And they can use their likely they can have a higher chance to defend their market shares against some of the aggressive pricing from the weaker competitors lah. And over time, they can also raising price and to enhance their profitability in the long run. For example, your iPhone or Apple products, because the mod is so strong, and the branding is so established, they can keep on adjusting their prices generation by generation lah. And the cost advantage for them is actually they continue to not much technology changes over time, so that each unit cost of their product actually went down as the unit number volume has been increasing. So their supplier also have to because Apple is so big, has a big bargain power. So whatever Apple demanded, you have to fulfill their requirement lah. Okay, there are some tips here. For investing in Singapore market, we can use some free tools like our equity tracker platform. Basically, it's sg.equitytracker.com. Later on, we will go through our website and using this tool to do some analysis. Of course, by reading all this data itself on our sg.equitytracker.com, you have to have some certain knowledge, but it's not a very very difficult kind of concept. But just if you know how to multiple, if you know how to plus or minus, it's actually that is enough, right? For doing some simple analysis. It's not a rocket science. Of course, if you are trying to pick some of the good companies, it involves some of the qualitative screening as well. In the future, if you want to do your homework to screen you some of the companies, you can please look at their business model, what the industry dynamics, modes, management as well, and certain red flags to avoid. And also that one thing that we don't like is that the company we are not worrying about a company keep on losing money. We are more concerning on a company that making negative cash flow or negative operating cash flow and have a very heavy debts, right? Because if a company that lose money, but have a very strong operating cash flow for the long term, the company still can survive no matter how, right? But if a company keep on making profit but without any cash flow, then that will be a concern, right? Okay, so for tonight, let's go to the important session for our tonight SGX event. So some of the case study, we have 3 case study tonight, and the first case study we're going to talk about is that, right, Sheng Siong. Who know about in the Malaysia might not familiar with this name, but if you're staying in Johor, or you happen to watch Singapore Media Corp Channel 8, you will notice that every weekend during the peak period, peak hour, they will have this show called Sheng Siong Show. They're actually playing some games and lucky draws. So they are a very established supermarket chain in Singapore, right? There are only a few players that are so established in Singapore, and Sheng Siong is one of them. And they are listed in 2011, right? Why we think this is a crisis-proof company? If you look at this share price, right, it's almost like a straight line. If you minus out all this minor volatility, right? Starting from 2011 to now 2025, the company share price actually grew by 4 times, right? Even the COVID-19 period, everybody thought like, right, business are going to be impacted and badly affected. And this company was just a minor dip, and it doesn't really drop as much as people initial thought, right? Some in Malaysia company, we can observe a 50% or 60% drop in share prices, but Sheng Siong, they are actually even shoot up during the COVID period, right? From $1.20 to $1.80, right? So until now, the share price is still significantly higher compared to when they initially listed. So in Malaysia, we quite hard to find this kind of company, right? A slow and steady, consistently growth kind of company. And this is just share price performance. Later, we're going to go through our system to look at what is their financials number look like. Or are they cheap or are they expensive? What is the trend for their previous financials performance? But if just compared to their previous IPO price, about less than 40 cents or 30 over cents, currently is 160, is about 5 times higher compared to the IPO actually. So it's really a resilient proof and kind of and this trend likely to continue. Okay, we received some of the questions. I know you got questions, but later on, keep all the questions to the Q&A session later. At the end of it, after I done my presentation, we have all this Q&A session later on, to answer all your questions. So a quick introduction on Sheng is that this is a supermarket chain that operate in Singapore that have 68 store, right? And when the company initially listed in 2011, they only have 23 to 24 supermarket. So right now they actually grow their store count by almost 3 times. So and you know supermarket, people still buy groceries no matter what, right? Even the economic conditions are bad, people still need to eat. Because it's a consumer staple, and this kind of company also they don't have any credit risk, right? So they will always receive the cash on the spot when you're paying to the cashier directly. So sometimes they can really enjoy very good cash flow from their customer and paying their supplier later. So their cash conversion cycle is almost instantly, and because they only need to pay their supplier later on after like 2 months or 3 months, they can really utilize their supplier money instead of their own money or borrow from banks for as a working capital. So for the company management, the company also has a very prudent and very experienced management, and by their leading, right, they actually won some awards like in the Singapore Best Consumer Service Company for many years, right? And because they're so understanding of their market, the new stores that they open is actually they call it heartland, right? In Singapore, what they mean by heartland is referring to areas that beyond the city center, but just near the HDB, right? Mostly public housing lah, under Singapore residents. So of course they also have some competitors, NTUC, FairPrice, Cold Storage, and Giant in Singapore. But Sheng is the only one who listed. They're actually doing very, very well. Okay. Of course, we must look at some of the competitive edge for this company. This is an established household brand name in Singapore. Their products quality is very good, and also because they have a very good management to control their product quality, they will test all the products when upon arrival, right? Because the company keep on growing and bigger, when they're doing bulk purchase, they also can enjoy economy of scale, right? Which means buying at a cheaper price. Then they also not more than a supermarket brand. They also house a lot of in-house brand as well. For now, I think they have more than 1,000 products, 1,500 to 600, 1,600 products, and they have 24 brands in their portfolio. And in Singapore, most of their Sheng shop actually open 24/7. Unlike Malaysia, most of the shopping mall or supermarket actually close at 10 p.m. Open at night 8 a.m. then 10 p.m. close at 10 p.m. They are some of the shops actually open at 7 and close at 11. And I think most of it is still open 24/7. It should bring a lot of convenience to their customers, right? And this company have very large network of supply chain, have at least 1,000 suppliers. It's like 99 Speed Mart in Malaysia lah. They're actually close to your taman, close to your house, and a very cheap price products, quality product as well. And these are their own internal house brand. This isn't all, just some of it. Basically, they have 1,650 products and 24 brands, in-house brand. And so which means they are somehow a brand owner as well. So usually when they have their own in-house brand, the margin for their in-house brand is actually much higher compared to just trading of certain products. And for this, they direct appoint some of the supplier or contract manufacturer to produce for them. There's they cut off all the middlemen, and they are not purchasing from the wholesaler, which means they can enjoy a lower cost structure and a higher profit margin for them. Okay. Now let's spend some time to go to the website we are talking just now, which is the equity tracker, sg.equitytracker.com. Let me present share. Okay. Can you guys see my screen? I think you guys can, right? Okay. Yeah, you can go to this sg.equitytracker.com and you'll find our equity tracker website. Yeah, I think my internet problem. Otherwise, all these have a very nice picture and logo to show up. Yep. Okay, this is normal. Okay. sg.equitytracker.com. And now if you look, notice at the right, upper right, you can just type any company. Like in our case, we're going to look at Sheng Siong. Okay. And then you can click on the company. So there's a lot of information here. Sheng Siong, let's look at the overview of the company. The full name is Sheng Siong Group Limited. And you see our prices is updated daily on a daily basis, and some of the data actually we updated in quarterly or annual basis lah. So for the financials, we will wait for the audited result, right? And we also got quarterlies. Okay, some of the stats here, just for your knowledge. The company currently market cap is 2.47 billion Sing dollar. So it's less than 10 billion ringgit, right? Or about 7.5 billion ringgit. The company is offering a dividend yield of 3.88%. Okay. For a consumer company, consumer staple, I think this yield is actually quite good. If you consider Singapore interest rate is just or FD rate is just 2.6 or 2.5, or your treasury bill for 6 months or 1 year per annum is just 3%, and the company here is offering you 3.8% per annum, plus that the capital appreciation over time, right? If you invested in since the IPO, your capital has been increased by 5 times for the past 12 years. right? 5 times in last 12 years is pretty good, decent investment, right? Okay, in terms of the price to earning ratio here, the company is just selling, I'm not just selling, well, the company is selling at 18.33 times of price to book, price to earning ratio. So if you compare to our locals, sort of players here, I'm not saying, I shall not name who, but if you look at some of the price to earnings in Malaysia, they are easily 30 to 40 times, right? Trading. So this is actually quite reasonable compared to Malaysians consumer staples. Okay, and if you continue to scroll down, this will have a brief description of the company where talking about what the company is doing, right? As a chain of supermarket, blah blah blah, and then what they offer is that they got live and fresh and chilled product, seafood, meat, fruits, vegetables, dairy, etc., etc. And here is the graph that is showing that at the current share price of 164, where they are compared to the 52 weeks high and low, right? And now they are in the actually the 52 weeks high side, and they never because the graph is a continuous go up for the past like so many years, right? They are always in near the higher end of the 52 weeks high lah. And if you continue to scroll down, there will be a historical price chart for this company. And for a company, for investor that looking for defensive stocks, defensive industry, and also crisis proof, dividend income is actually a very important factor. So that we list out all the dividend payout here for the past as this can track, right? Until you can see actually the company is paying 2 times dividend a year, and it's quite confident they're going to have dividend in July, right? Normally last year they pay in 2022 they pay like in February and July. 23 pay in February as well, right? Okay, we're showing some yield here. Okay, and this is over time graph for their net profit, revenue, and operating cash flow. So for long term, the company continue growing, right? In terms of revenue, net profit and cash flow. So if you point up to whatever year, it will show you the numbers. Basically, we have until 2023 now because the annual report haven't been released yet. Because we only key in the audited number, right? Okay, if you click on the uncheck the revenue, you can notice that look at clearer at the net profit and operating cash flow level. So there are few financials or key financials metrics that we should look at just now, right? As we mentioned. So let's look at the financials here. Okay, when you click financial, we actually show you the 10 years profit and loss statement. In you can quickly go through. Basically, turnover is their revenue. Starting 2014 until 2023, the company actually grew their top line from 725 million Sing dollar to about 1.3 billion. All right, it's almost it's actually double, less than double. All right, but however, because their cost structure is actually quite fixed and they enjoy that economy of scale, you can notice that their net profit actually grew more than double from like 47 million or about 50 million in 2014 to now 2023 about 133 million, right? It shoot up almost 2.5 times higher. So because of that their cost is mostly fixed, and all the increasing in their revenue actually goes pass through directly to the bottom line. Okay, there's a lot of financials here you can look at. Okay, another very important thing is that we always look at cash flow. So we also give you this 10 years cash flow. The company is generating much higher cash flow compared to the company net profit. Let's say the company is making 47 million profit, but in terms of the real cash flow the company is getting, they are actually getting 70 million, right? And in the 2023, their operating cash flow is 177 million and continuously generating a positive operating cash flow for the past 10 years or more. Okay, so if you continue to scroll down after the cash flow, we'll see balance sheet. All right, the company has a quite cash rich company with 300 million of cash in the bank and almost zero debt. Right, they got no borrowings. So for this kind of company, the bank owe them money instead of they owe bank. When the crisis come, they won't chop up lah. All right. And of course, we got a lot of quarterlies. We have comparison. Who are their competitors, right? Shareholdings, right? Who are the largest shareholders? We show their top 20 shareholders. You can see a lot of funds here, HSBC, whatever. And the capital and dividend info. There's no capital changes for the past history, but we show you the dividend payout already. Also, we show you who are the directors. All right, what is their name? Who are they? All right. Okay. We last updated here is actually 22nd of March for this director name list. Okay. So this is a quick run through for our first case study. We talk about revenue, we talk about profit, we talk about cash flow, we talk about dividends, and we talk about debts, right? Basically fulfill every single criteria. Okay, if we can continue, the last important part is, okay, since Chris, you're saying that this Sheng Siong is so good, is this the right time to buy now? Because the share price is near all-time high. Okay, now let's look at the company price to earning ratio. And because the price has jumped 5 times higher compared to the IPO price, let's look at the valuation. Is the company 5 times more expensive compared to the IPO? The answer is no, because if the company, although the earnings has jumped significantly, although the share price has jumped significantly, the earnings also increased quite tremendously. So if you look at the price to earning ratio for the all history wise, the current PE of about 18 times is relatively at the lower end of the all history, right? Since the company listing. Previously, they are trading. I think here, I'm not sure what happened here. Maybe it's the sharp increase in earnings, so the PE has dropped. But overall, the company has been trading around at a range of 20 to 26 to 27 times price to earning ratio. So for this company now, it's actually trading at 17 to 18 times price to earning ratio. So which means at a historical low, the timing risk here is relatively low, right? You are paying only 18 times compared to the previous guys that are actually paying 20-25 times price to earning to buy the same amount of shares. Okay, so yeah, in terms of valuation wise. Okay, now let's go to another case study. Just now I saw some member or people asking about REITs, right? Because just now also mentioned that healthcare sector is a non-discretionary sector, right? No matter how people gonna get sick, they have to seek for treatment and they have to pay, right? So the hospital will always have business one, and but in case for Singapore market, we look at REITs. Why? because Singapore REITs is actually much more, they have a lot of REITs that listing in Singapore, and I think they got 42, if I'm not mistaken, compared to Malaysia less than 20. So is the REITs is really vibrant in Singapore. So for this case, Parkway Life, they are the company is actually have a range of, they are the one of the ASEAN largest healthcare REITs in the region. So what is mean by REITs? All right, for those who are new here, REITs, REIT, means real estate investment trust, right? It's they hold a lot of properties, real estate, right? They invest in all this real estate, and when they get the rental income, they will pay that rental income as a distribution to all the unit holder, all the shareholders lah, basically. So it's some kind of like dividends, right? You're getting dividends, and a very stable dividend. For REITs, normally all the REITs will pay more than 90% of their earnings, right? Almost 100%, 90% of their earning at least to the all the shareholders, right? So the REITs owner can getting a consistent income by investing in REITs. So another crisis-proof kind of investing for this Parkway Life REITs, they are listing a bit earlier compared to Sheng Siong in 2007, and the share price also keep on increasing until now, also by 4 to 5 times. Or for a REITs, this is a very good set of share price performance. Okay, and for Parkway Life, they not only have a lot of hospital in their portfolio, they also have some nursing home, right, in Japan. Most of the portfolio is actually nursing home in Japan. As you know, Japan has a very quite a high aging population there, so a nursing home is a necessary in Japan. And hospital, normally you hard to see hospital actually go bankrupt, right? Because hospital also collect cash upfront. They also, when you seek for treatment, they also going to claim from your insurance company before you can admit or go do an operation. So hospital is consistent cash flow, right? And they're going to pay their rental no matter how lah. So this is also kind of resilient business for this Parkway Life REITs. Okay, I got some introduction on Singapore REITs, largest REIT market in Asia, excluding Japan. There's 42 Singapore REITs, and also is a very important component for Singapore stock market. For Singapore, I think about 10% of their overall market cap is actually are Singapore REITs. And as I said, they distribute almost all their income to their unit holders, to their shareholders, because if they pay less than 90, they have been there will be tax for them. If they pay more than 90%, they will not charge any tax to the REITs management company lah. Yeah, in Singapore, they also have an exposure to global real estate. Over 90% of Singapore REITs own property outside of Singapore. So it's a very diversified kind of REITs in Singapore. So how diversified it is, you can see there are a few subsector: industrial, hospitality, diversified, retail, office, specialized, and also healthcare REITs. Okay. Now, let's go back to this, our equity tracker. If you look at equity tracker, you can notice that there is risk guru, right? We also, because risk is so important for Singapore investor, we also have this. But for now, we can just also click on Parkway Life. See? Pop up. Okay, some of the price statistics that this REIT is actually generating 20% of price return performance for the 1 year basis. It has a market cap of 2.2 billion Sing dollar as well. And the closing price of today, closing price is at $4.15. Okay. It also near their 42 weeks high. The current yield is not as attractive, just 3.62%, but is somehow compensated by the capital appreciation. So because we track a lot of data here, we also show you that what is their gearing ratio, right? Gearing ratio means how much debt they have, right? Because you like any a home buyer, we always borrow from banks to purchase our properties, right? We seldom to using all our money to purchase. So most of the REITs have certain borrowings, and this gearing is a ratio that measure how much you have been borrowed compared to your shareholders fund. And for this case, is they just borrow like less than 40% and 35.6%. And we have this occupancy rate. This is very important because you want as high as possible occupancy rate so that you have less problem to manage, right? And you are fully occupied lah. The best is this, near to 100% already, this one. Okay, how many properties they have? They have as a 23, they have 63. The revenue segment from here now we can see there's a breakdown. 70% are hospitals and medical centers. 30% are nursing homes. So we can beside Parkway Life, right? Let's go back. If you click on REIT Guru, you can actually do some comparison for every REITs, right? You can click on compare, what type of REITs it is, what is their rate, how much is that, what is their property type, industrial, what's their yield, etc., etc., right? So it's very informative, but what more insightful is that if you go back to the company Parkway Life, we actually capture more data point that, right? My connection is a bit slow. Let's refresh yet. Okay. If you continue to scroll down, you'll notice that we also have shown you the latest dividend payment for REITs. Okay. Now is the important part. Very interestingly, we actually show you where their property are located. Right. For this case, they got they got 51 properties in Japan, right? 51. They got 3 in Singapore, and yeah, they got 3 in Singapore, and then 3 in Malaysia. 3 in Malaysia and 1 in Malaysia, 3 in Singapore. All right. Okay. And this is their historical revenue as well. And what is their gross floor area? How many? Currently, they're 3.9 million. Okay. And if you keep on scrolling, you notice that the revenue segmentation. If you click this yeah, you can select the asset type here, and for this company have hospital and medical center. If you uncheck this, you'll notice that the hospital medical center is actually consists of about 70% of their earnings. And then nursing home is actually about 30. Again, there are others, pharma, manufacturing, distribution center are just 1% or even 0. They exited this business, right? Revenue by geography, this is the Japan. Japan consider about 30%, Malaysia 0 point something percent, and Singapore are actually again 69%, right? Yeah, now we go also capture their what is their list of property, and this is all their properties. So we can click on one of the property. It will show you this property they have I don't know how to pronounce, as Nakaurawa in Japan, and this is have a 4+1 basement stories, Nosinke home with a 64 unit of bed. And how many? It's a lot of location information here, and what type of property they have, the location, what is the revenue, what is the purchase price, and how many tenants are there, right? You can actually observe the occupancy here. So they have all these 63 properties. We all have data for every single one of them lah. So you can actually spend some time to explore this. Yeah. If we want to capture the parking lot number, how many parking lots they have, right? This is how powerful it is, and this is all available for everyone for free. So don't waste this opportunity to using these powerful tools, right? Okay, now we can go to our third case study, which is DBS. I think again, we look at the long-term share price starting in 2003 until 2025, almost also you can see the share price increased significantly by also about 10 times, okay, for DBS. So basically DBS is also one of the defensive company in the region, or especially in Singapore market. Why we say so? Because that DBS has a very large base of their total asset. If you look at the total asset for DBS Bank, it's 509 billion US dollar, right? Top three are actually Singapore banks. But if you look at the 509 billion, if you are a Malaysian investor, you think that Maybank is big, you think that CMB Bank is big, and you think that Public Bank is big. But DBS Bank, one bank itself, their total asset is actually still larger than all three banks of Maybank, CMB, and Public Bank combined. So can you imagine how big it is for DBS? So as a asset base is larger, the amount of impairment or actually can be, they can actually spread out all the risks because the asset base is so huge. So whenever there are impairment amount has incur, compared to the large asset base, they actually have a lower provision, and they can generate higher return on equity as well. Right, just show you some stat. The top three banks in Singapore is actually 1.2 trillion, and compared to 473 billion in Malaysia. And there are three listed banks in Singapore Stock Exchange: DBS, UOB, and OCBC lah. Of course, they are somehow competitor in Singapore, but I think Singapore is not the core market for all these three banks, but they are a regional play. Okay, what are the outlook for DBS? This is extract from their investor presentation. The company forecast that the 2025 net interest income will continue to above 2024 level. So basically, it's a good news. The non-interest income is likely to grow high single digit, right? And the cost income ratio going to be in low 40s range, right? This is as slow as possible lah. It's a good sign for banks that actually have reported lower cost of income ratio. Okay, I won't go down every single one, but yeah. So people might think, 2024 banks, DBS reported a very good set of result. So is the profit going to sustain? The CEO actually mentioned that, hey, yes, we are at least going to be around 2024 level lah. Okay, pre-tax profit level, but net profit, because of the global minimum tax of 15%, and they have operation across the region, so some might enjoy lower tax, but going forward they no longer have this benefit. So their net profit wise going to be slightly below 2024 level, right? And this is what they tell the investor. So if we go back again quickly, we can run through this research for DBS. Okay, look at how well they are doing. We look at the financials for banks. Okay, For this bank, the 10 years profit and loss is also increasing from 8.9 billion um, to 27 billion, right, for the past 10 years. Fantastic, right? 3 times higher. Operating profit also significantly higher. Net profit also doubled. For this giant, they can grow double their earnings is actually not easy. It's actually good accomplishment, and kudos to the management lah. Okay. Of course, banks cash flow is a bit tricky. We cannot using the same concept of like a manufacturing company, how they manage their cash flow to for banks, because banks cash flow are a bit different. Their business is just taking in deposit and borrowing money to the lenders, borrowers, right? So the cash flow is does not apply for banks lah. Right? And also the balance sheet, how much debt they have is also not applicable for banks, right? Okay, what is the valuation for DBS? This is the historical valuation, and we're using price to book ratio to see whether it's a good time to invest in DBS. So actually DBS is currently near 2 times price to book. It's not a very cheap prices, but it's near their historical high. But it's still a very good banks. But if you have want to buy in this DBS, it is also prudent to have a dollar cost averaging method. When the share price drop or even the valuation become cheaper, you buy more when the share price drop. Okay. Yeah, I think I share these tips again. This is just a quick recap. I think we have mostly covered everything. So what are the action plan for you as an investor after listening to this webinar is that you can create your own watch list to identify some of the stocks, put in your watch list and using our sg.equitytracker.com, and do your own research and validate the numbers and assumption. Trying to read some annual reports and some of the company presentation. If you became a shareholder, do attend their AGM and listen to the earning calls. Okay, of course, using our website to do your research. And before you're buying, set your buy entry strategy, and also after buy, track and review and rebalance always. Okay. Again, this is some of the summary for our SGX-Winners. We actually have some of the algorithm we filter out for you, pre-filter about what are the rising star that actually continuously grow their profit for the last 3 to 5 years, and who are the dividend kings and mod defender, etc. There's a lot of function to be explored, and spend some time to explore, please. And we also have this trading ideas that if you are have an interest on the trading, please explore this as well, because we actually pre-filtered some of the stock that actually have good liquidity and also volatility for trading purposes. And then you can scan this QR. Let's quickly go to some of the Q&A questions that we have. Maybe we answer a few questions. Okay. Chris, how about REITs industry in Singapore? Please help to share fall into consistent dividend and resilience. Yeah, I think I shared. Depends on what type of REITs. If it's like hospitality REITs, it's actually quite stable. If it is shopping mall REITs, then during COVID period, of course they will be affected lah. So industrial REIT are mostly it also depend what type of industry they are in. If they're in their support in the overseas, or their portfolio are diversified, consists of diversified portfolios from various properties around the world, then they could be still generating a good consistent dividends for the investor. How to determine cheap and expensive? I think every single company have different criteria. For banks, just now we shared, we're using price to book. For some of the manufacturing or like Sheng we're using PE. Right? So and of course, valuation is still some kind of arts. There's no one formula that actually can apply to make a judgment call. Because every company, every single investor will have different willingness to pay for a company, right? So yeah, but yeah, do compare the valuation compared to historical valuation and their peers, so that you have a sense that how what are the current prices are trading at. Okay. I think does Samsung have footprint in Malaysia? No. Right. Okay, why Parkway has more than 50 property in Japan? Okay, because they can see they are maybe they are starting in Japan, they can list in Singapore, right? There's no restriction on whether they own properties anywhere around the world. You can explore. There's a lot of REITs that actually own a property in America and US. There are plenty lah. Missed the previous slide, possible to show again, and you can always rewatch this recording. All right, it will be keep in our YouTube channel and also our Facebook. Can we use our EPM to track a portfolio in Singapore stocks? Unfortunately, we don't have that functions for now. Sorry, Aoyang. Right. Maybe you have but you can always using the same methodology that manage portfolio for a Singapore stock as well. Is apply for Malaysian stock and Singapore stocks. It is the same. Okay. Any more questions? I think I answered most of the question. I think all the questions are answered. Okay. So we have talked about a lot of criteria to how to select a defensive stock in Singapore. Like look at ROE, look at cash flow, look at find companies that have low debts, and also prudent management, right? So that can weather through the crisis. And they have to show their track record and also the capabilities on how well they manage their capital. So I hope you guys learned something from tonight's session. It's my pleasure to share with you on Singapore market. If you have any questions, you can continue to comment in the session, in the comment section, so that we can keep on have some our idea bouncing together lah. And thank you for the past almost 1 hour together staying with me for the XGS section. So that really appreciate all your time. I think if there's no question, then we can call it a day. I hope you guys have a good day tonight. And almost we have near to our Hari Raya already. So for all our Muslim friends, Selamat Hari Raya in advance. For those non-Muslim, happy holiday. Okay. Thank you. And I will see you very soon. And good night and goodbye.